Question 1. Valley View Corporation reported that short-term investments consisted of the following. And this is for December 31, 2013. The corporation had available for sale securities investments. Cost is 528.3, fair value is 528.4. Trading securities. Cost is 62.2, fair value is 52.2. And we have the totals provided. Now recall that available for sale securities are reported on the balance sheet at their fair market value. The same applies to trading securities. They are also reported at their fair market value on the balance sheet. This requirement is because both of them are passive investments, and passive investments are investments for which the investor has less than 20% ownership, and the investor is considered not to have significant influence over the investee. Now, the fair value or the fair market value is the price in the market, the stock price, or the market price of the securities. So December 31, 2013, the prices of the available for sale securities and trading securities are provided. Now let's go through the options and discuss them. A. Valley View's 2013 balance sheet includes short-term investments of 590.5 million. Now, A reports the cost on the balance sheet for the available for sale and trading securities. That cannot be correct because these securities are reported at their fair market values. Let's skip to C. C states that there are no net unrealized gains on available for sale securities. Now let's look at the available for sale securities. The cost is 528.3. Fair value at December 31, 2013 is actually greater than the cost. 528.4 implies that there is an increase of 0.1. Now that increase in value is an unrealized gain. It's a gain because it's an increase, and it's unrealized because the securities have not been sold. So C cannot be correct. Let's look at D. Accumulated other comprehensive income included no unrealized gains or losses. Now, unrealized gains or losses for available for sale securities are reported in accumulated other comprehensive income. So if there is an unrealized gain of 0.1, then D cannot be true. Indeed, accumulated other comprehensive income would have the unrealized gain of 0.1 for available for sale securities. So let's look at the correct answer. Unrealized losses of 10 million on trading securities are included in 2013 income. Now, first off, any unrealized gain or loss on trading securities are reported in income or the income statement. The reason being that trading securities are a category of securities for which the investor is actively trading. So trading securities are actively traded securities. So any unrealized gains and losses are reported in income because they are considered as part of the company's operations. Now, the cost is 62.2 and the fair market value, the price has declined to 52.2. So there is an unrealized loss of 52.2 minus 62.2, and it's 10 million. So that makes B correct. Let's now move on to question number 2. Bally Corporation purchases an investment in Monte Carlo at a purchase price of 8 million in cash. Now, this investment represents 30% of the value of Monte Carlo. Now, during the year, Monte Carlo reports net income of 1 million and pays 200,000 dividends. At the end of the year, the market value of Bally's investments is 8.5 million. We are asked to determine the year-end balance of the equity investment in Monte Carlo. Now, first point is that the accounting for any investment depends on the percentage of ownership. Now, for 30% ownership, we are in the range between 20 and 50% ownership. And the equity method of accounting is used for ownership between 20% and 50% of the common stock outstanding. Now, under the equity method, we do not use the fair market value. So what it means is that this market value is ignored. So how do we determine the ending balance of the equity investment? Equity investments for which we use the equity method of accounting implies that the investor company has significant influence over the investee. Because of that, the investor company recognizes a proportion of the net income and dividends of the investee based upon its percentage of ownership. So let's begin our analysis. We start off with the value of the investment purchased, and that is 8 million. So that is our beginning balance. We recognize a portion of the income reported by Monte Carlo, and it will be 30% of 1 million. That gives us 300,000. That portion of the income is added to the investment account. However, dividends are subtracted because they are considered as return on investment. Just like how dividends are subtracted in retained earnings because they are considered returns. So we subtract the dividends, which will be 30% of 200,000 because the company owns 30% of the shares. So it gets 30% of the total dividends. So the ending balance will be beginning balance plus the investment income less the dividends. And we have 8,240,000. Our last question is on consolidation when a company has 100% ownership of the investee. Indeed, parent companies consolidate their financial statements with subsidiaries if they hold greater than 50% of the common stock outstanding. In this case, it's 100%, which means a wholly owned subsidiary. So Tempotech is a wholly owned subsidiary of Cadence Corporation. Cadence purchased Tempotech for 6,362 million. On Cadence's unconsolidated accounts, it uses the equity method to account for Tempotech because it holds that as an investment on its balance sheet. Now, Cadence uses the equity method on its unconsolidated financial statements because Cadence invested in the stock of Tempotech. So that investment will be an asset on its unconsolidated financial statement. When Cadence decides to consolidate, let's remember that the assets and liabilities of Cadence will be combined with the assets and liabilities of Tempotech. However, the equity of Tempotech will not be combined with the equity of Cadence in the consolidated financial statements. The shareholders of Cadence are the only ones who have that claim to the assets and liabilities. Now, let's go through the answer options, and we'll be applying our understanding of consolidated financial statements. Option A, the consolidated shareholders' equity exceeds the unconsolidated shareholders' equity by 6362. Now remember that the unconsolidated shareholders' equity is for Cadence Corporation before it does the consolidation. And we are being told that when it consolidates, its shareholders' equity will increase by 6362. However, we know that when a parent company consolidates with its subsidiary, we do not combine the shareholders' equity. We only combine assets and liabilities. So A is incorrect. It cannot be true. Let's look at B. Consolidated total assets are greater than unconsolidated total assets by 6362. That cannot be true because we combine the assets of Cadence with the assets of Tempotech in the consolidated financial statements. So the difference between the consolidated total assets and unconsolidated total assets should be the assets of Tempotech, not the equity of Tempotech. So that also is incorrect. Let's skip to D. The consolidated net income is greater than the unconsolidated net income. Now this is incorrect because Cadence owns 100% of Tempotech. So in Cadence's unconsolidated income statement, it will recognize 100% of the income of Tempotech. And then when it consolidates also, it will be combining the revenues and expenses of Tempotech with its revenues and expenses, which will mean that it will be recognizing the net income of Tempotech. So the consolidated net income is the same as the unconsolidated net income. Now, based off on this understanding, we would go with answer C. So C is true.